I'm quite excited for this panel. Stablecoins, as we know, has been in the picture on the grandest stage in the world, really. And I've got a fantastic panel here that are, really deep into this. But let me actually check in with his audience. Like, who of you has, raise your hand if you have sent money internationally. Keep your hands up if that money arrived in a few minutes and under $1 or a pound. Oh, stablecoin user there. So yeah, that's what we are diving into. Like, stablecoins in 2024 processed 27 trillion in dollar value, bigger than Visa and MasterCard combined. And so the question for the panelists here, and I'm not going to introduce them right now, but they can reveal themselves, is, so don't take that wrong, right? Is actually like, because it's bigger than Visa and MasterCard's, processing in dollar value, are we still looking at the future of money, or is it maybe that, we're a bit late to notice that it's already here? Oh, you can do it. Yeah, you can.
Yeah, thanks for having me here. My name is Allesio. I'm the CTO of Yellow for research and development of Yellow Network and ClearNet, the protocol, and also in charge of developing the white paper. Yeah, the answer is yes. Future of money, also the present. Short, brief answer. Sorry, thanks. Thanks for having me here.
Next.
Yeah. Yeah, stablecoins are definitely the future of money. I think if you look at the first Barclaycard Visa card was launched in the UK in June 1966. And if you look at, obviously, contactless is now ubiquitous. In London, you see everyone using the phone, but beneath that is say, a credit card, a debit card. And pretty much it's the same payment architecture behind that card as when Barclaycard launched a Visa card in 1966. So as you can imagine, Visa and MasterCard are very mindful of stablecoins' capacity to completely disrupt their business model, and they're both actually actively launching stablecoin projects. For example, Visa have piloted Visa Direct to be a B2B service with stablecoins. That pilot is going at the moment. So I think the fact that, stablecoins' capacity to go cross-border at low cost, a fraction of the cost of traditional payments, instantly you can get Tether, just send, someone can send you Tether anywhere in the world and you get it instantly. I think, without a doubt, an answer to the question you made, stablecoins are incredibly disruptive technology.
Okay, Marc, do you have a view on this?
Yeah, I do have a view on it. We've been using stablecoins for probably about 8 or 9 years to send units of value around the world. Principally, we started with commodity traders for whom fees are really important because their margins are small and time is critical. If you have a ship of bananas off the coast trying to get into port, and whether you can land that ship today or this afternoon, or this morning or this afternoon, there's a difference between making money and not making money, and the whole time delay is dependent on whether the payment is cleared or not. You want to know that that payment arrives within just a matter of minutes, rather than whenever the banking system decides that the correspondent bank is going to say, yeah, the funds are available. So we've been using it for the longest of times, and I think, to me, the biggest indicator of stablecoins delivering on the promise of Bitcoin, being able to send a unit of value over the internet without an intermediary and leave one place and arrive in the other with finality, is best indicated by the fact that Tether, one of the largest, if not the largest stablecoin providers, is up there in the top 20 holders of US government bonds. And I think that shows everything that you need to know about whether stablecoins have reached a point beyond inflection, where they are a critical part of the infrastructure. I think the big question now is with regulatory frameworks like MiCA, which was created to kill Libra, which was a stablecoin that Facebook were thinking about bringing out, and a Genius Act, which is intended to allow the US to leverage the opportunity of stablecoins. I think governments, regulators, and facilitators are waking up to the fact that if they don't allow innovation around stablecoins to occur, there could be systemic risk to their financial capability within at a country level, at a sovereign nation level.
Okay. Marc?
Yeah, I think we are looking at the future of money. I mean, I come at things from a slightly different perspective because I'm less on the payments and transfer side and more on the role that stablecoins play in DeFi and the role that DeFi plays in helping to grow stablecoin supply. At Euler, we have a protocol that lets you lend and borrow assets, and the vast majority of assets being lent and borrowed today are stablecoins. We've got around 4 billion in total deposits and up to 2 billion in active loans, and people like to trade these things. A lot of stablecoins, it's not just about the stable dollar value that people like, but a lot of stablecoins come with a yield-bearing component where you can deposit a stablecoin into a savings mechanism of some sort to earn yield. And these products are exceptionally popular as a yield generation strategy. And in DeFi, we've now got hundreds of billions of stablecoins in circulation, and as people borrow those assets, Robin, if you borrow $100 from me at 5%, in a year from now, there's an extra $5 of stablecoins in circulation. So DeFi is helping to grow the stablecoin supply, and that's why partly why we're seeing such explosive growth, aside from the payments part of the process of transfers, cross-border, all that stuff. DeFi is very, very much playing an important role in the growth of stablecoins.
Yeah, it sounds like it's already here, right? Like, hearing from each of you is just from another perspective. Like, stablecoins is just integrated in your day-to-day and stuff. So, from my point of view, like as a consumer, I actually use some consumer apps that are leveraging stablecoins, and I always wonder, like, how does it work end to end in a full stack kind of environment? Because we've got infrastructure here, we've got payment rails here on stage, and as well, on the settlement side, I think. Like, from each of you, I would love to know how that looks like, the full stack of stablecoins. You want to go first, Marc?
I'll pick it up with a little bit of a negative answer and tell you where I find things to be a huge pain in the ass around stablecoins. So we have a regulated business out of Switzerland that caters to high net worths and acts as a bridge between crypto and fiat. We can send a unit of value, oftentimes multiples of tens of millions on behalf of a client, from one point to the other within just a couple of minutes for just a few cents. And that is fantastic. What sucks like hell is having to do the KYC and the AML, which is like from the Stone Age. So when we're sending units of value that leave and arrive in minutes, prior to that, we have to go through a whole process, which is almost akin to carving your name on a stone tablet and then finding 5 slaves to walk it down to the regulator, have it translated on the way into something that the regulator can understand, recarve that onto a piece of marble and deliver it to the right person. It's antiquated, it is out of date, it's inappropriate, it is meaningless, and it really is not fit for purpose whatsoever. So from my perspective, that interface point is where the huge weakness is and where the huge delay is. So to put joking aside, we might be looking at a process of 3 to 5 days to onboard a new client because of those AML, KYC, KYT, and good requirements that we support the need to do, but we're using such antiquated processes that it almost feels a joke. 3 to 5 days to onboard someone, 2 or 3 minutes to complete the transaction. It's just meaningless, and that, you might have gathered, is where I have a degree of frustration, mostly with the old world establishment, so the world of Web 2 versus Web 3, and where regulatory frameworks like MiCA get rolled out, and effectively you take a bowling ball and try and force it down a hose pipe, which is the world of stablecoins, just because, frankly, someone's lazy or the regulators are receiving lobbying from the established firms in a very effective way, if I may dare as be so provocative.
Yeah, and on the consumer side, it's easy to forget when you're in crypto and Web3 how we're still niche. Mercuryo, we recently did a survey with Protocol Theory, and it found just on adoption and usage of cryptocurrency, and many consumers, while we found it was of US consumers, and while 80% had used Venmo and Cash App, it was a far smaller, I think it was almost like 12% that actually were using crypto wallets, Web3 wallets. People still find the interface of like a MetaMask, or, well, not want to single out one particular provider, but any Web3 wallet, people still find it clunky. You know, there's things like bridging between, you might have a stable coin on Ethereum and you need to bridge it to Arbitrum, etc. This is still very, if you're in crypto and you're doing this, it's easy to, you have to take a step back. The man on the street who's not in crypto finds this completely unintelligible. And while, you know, like MasterCard, Visa, the traditional payment networks, they're, as mentioned, you know, this is a payment system that goes back for more than half a century. You could say it's archaic, but in terms of actually bridging that gap and bringing stable coins into mass adoption using Web3 wallets, there's still a lot of hurdles to go, just in terms of people are very sticky. They still use credit cards, debit cards, traditional payment methods, and it's going to take a lot to really disrupt that, even though we're here in terms of the technology, in my view.
We're trying to make it last, we're trying to make it, it's not going to take much, thanks to us. Because, okay, although we are not focused on stable coins, so answering the question end-to-end is frankly quite impossible, because we are not focused on stable coin. But what Yellow does is definitely take on taking a stab at solving the problem of adoption. And adoption means usability, firstly and foremost. Meaning that, how do we do that? And that's perhaps in a way relates to your question from end to end. We build a platform, a comprehensive toolkit made of, well, technical things, building blocks, which aims at simplifying the experience for the developer to build decentralized applications. Building a Web 2 application is a completely different experience than building a Web 3 application. And Web 3 applications, from user perspective, are the completely different, they offer a completely different journey. We started from, you know, it feels very bad to expect the user to memorize or create 2 hardware copies, put them in a safety box of a memorable phrase, 24 words, which is impossible. It's nonsensical for us. So we created the state channels and the Yellow SDK on top of this clearing protocol, decentralized clearing protocol that we leverage in order to provide our clients, users, and developers with the tools that they can use to build their stable coins, the utility coins, so on and so forth. And we've been quite successful so far. Building with the SDK, you can connect your AI tool and even building a skeleton with it. The thing is, stable coins, there is a demand for stable coin. I heard frustration, I heard main street. If you really want to bring stable coins to the main street, you need to make them look like they're accessing their own banking, fundamentally. But developers cannot develop those apps because of how development tools, how tricky and anti-UX development tools are.
Yeah, in that regard, right, usability is super important. And this is a sentiment that is quite out there. A lot of people feel there are too many stablecoins. Like if you use USDT, USDC, and then you have synthetic stablecoins backed by gold, stablecoins backed by my shoes, whatever, right? I would love to hear your guys' view, because you guys are builders in the space, what you think of this, there are too many stablecoins.
Nonsense. I think there's, so we actually announced just last week that we're about to launch Euler USD, our own stablecoin. So you can probably gather that I don't think there's too many. I think we need at least one more. But no, in all seriousness, I think there's going to be, if you think there's too many now, just wait for another year. You'll see hundreds more coming online, truthfully. Most of this is driven by the yield side of things. So what happens with a lot of these stable coins is the dollars go into a bank account, they generate yield. And at the moment, the companies are mostly keeping that yield. But there are many other ways to collateralize a stable coin in a way that generates yield, and a lot of new projects, newer stable coins are finding creative ways to distribute that yield back to back to the holders. And that's why I think we're seeing a proliferation of stablecoins at the moment. Euler as a platform, as a DeFi platform, is really like a hotbed for growing a stablecoin as well. Credit markets in DeFi have been growing very, very rapidly over the past year, Euler included, but some of our competitors too, and it's because of the immense product market fit that credit markets, on-chain credit markets have in helping to grow and distribute stablecoins. So I think from the standpoint of somebody that just wants to transfer a stablecoin from A to B, it would be nice if maybe there was just one and we could all agree which was the best one. But that's not the only use case for a stablecoin. There's many other use cases out there, and the type of collateral that backs your stablecoin is a really important differentiating factor for that stablecoin. As you said, some of it's T-bills in a bank account or held with the bank, but increasingly we're seeing all sorts of novel collateral types onboarding from, I've seen one recently which is backed by an AI startup generating yield from renting out compute, for example. But yeah, we should expect a lot more.
And I think, Robin, I would agree with Michael. I don't think there are enough stable coins at all. If you look at stable coins at the moment by volume, you have Tether and USDC. Tether is not allowed to be used in Europe, thanks to MiCA. USDC is highly prevalent around the world, is allowed to be used within Europe because they have become compliant under MiCA a long, long time ago. But those two projects have a very distant third place and fourth place. You're talking about 7 to 8 times a drop-off in size before you come down to third or fourth place. And if all you want to do is move a unit of value around, then you could argue that USDC or USDT is absolutely fantastic. But it comes back to utility. It's not just about moving a unit of value around. It's not just about moving a unit of value between the 5 of us, the 4 of us. It could be within a supply chain where the participants all get together and decide they're going to create their own stablecoin within that little conclave of users, and maybe they back it with their own equity. And therefore, there is an added incentive for them all to be good players and exchange units of value between themselves. And what I see with stablecoins, what really excites me about the opportunity of stablecoins, as I said earlier, is it takes the promise that BTC created for us, way back, for those of us that were in the market then, as being able to deliver a unit of value over the internet and provide the method by which to exchange a unit of value without an intermediary, leveraging cryptographic proofs to make it secure. Now, stablecoins are fantastic because they've moved on from that basic premise and actually created utility beyond BTC. And for all my BTC bros back to 2010, I'm sorry, but hodling BTC is just not a good use of it. Now suddenly with stablecoins, we have some real utility. But it's not just for payment. It could be for yield. It could be to support projects. It could be for untold matters around innovation that we don't know yet, particularly when we get to an agentic economy where it is always on, and we, by dint of the fact that we're humans and we need to sleep, are not always on. So having stable coins available to us to be able to support this agentic economy in an era where the internet is 50% driven by automats and agents anyway, with the creation of content and activities, it's a perfect match to support that agentic world that we are moving towards. And I think more and more stable coins. So for those of you that want to build in this audience, go to the US and build stable coins.
Do you see any systemic risk, though, with the proliferation of all these different stablecoin issuers that, for example, some might not be fully backed?
Yeah, so I'll add a caveat to that. My opinion of how stablecoins should be created is that they should clearly always be backed, and always be auditable, because it's a little bit like trying to call a pig if it doesn't look like a pig and squeal like a pig. It's not a pig. Stablecoin should be backed because the very clue is in the name. It needs to be stable to an asset and linked back to an asset and prove that it's linked back to an asset through audit. Otherwise, why would people have confidence in it? It's a Ponzi.
Yeah, I mean, I quite agree that they should always be backed. The quality of the collateral backing an asset, though, is important. I mean, it should be liquid collateral. Euler USD will be a synthetic stablecoin backed by a variety of different assets. So there'll be some crypto native assets like Bitcoin backing it, but also real world assets like treasury bills, all the collateral will be on-chain, visible, yeah, very transparent, and hopefully very liquid. And that's the key design for Euler. But yeah, there's ultimately different stablecoins with different backings will have different yield properties, different risk properties, and it's up to the free market to decide what it prefers really. If you just want very low yield, very stable, then I think being backed by treasuries is maybe the best approach. But if you want elevated yields, you want to have backing from crypto native sources, then let's see what the market wants.
And how do you see it sort of linking with the crypto market? Like you're in the DeFi space, because if there is extreme market events, with some of the leading stablecoins, these extreme market events tested and they came through with flying colors. But a lot of the more and more stablecoins have entered the market, how do you see that link from your experience in DeFi or crypto markets? If there was an extreme event, could that maybe impact some of these issuers?
Yeah, absolutely. I mean, it really depends on the liquidity that's available on chain and the transparency. I'd say one thing that's great about DeFi is that the collateral backing an asset is transparent. If you look in TradFi, when things collapse, often it's very difficult to piece together what the collateral was that was backing any particular product. And it's often very fragmented. Whereas in DeFi, we have open networks. You can see how liquid a particular collateral type is at any given time. You can look at the particular collateral set backing a given stablecoin and make a judgment. Extreme events definitely pose challenges, though. I think if on-chain liquidity thins out, then that will be a big challenge for stablecoins. When there's volatility, often the collateral needs to be sold off and used to buy back the stablecoin so that it holds its peg. If the liquidity is just not there for that, then eventually stablecoin can depeg and that cause losses to the stablecoin holders. So yeah, it's definitely a risk, but I think so far we've seen that DeFi actually does a very good job of enabling this when the assets really do have backing and they're not some of these algorithmic types that you alluded to. I think so far we've seen very few issues with those types of assets.
And Joe, I think it's a great question. Even the non-algorithmic stable coins, and I'm thinking back to Circle a few years ago where they had cash on deposit in a US bank, and that US bank had a run on it, and Circle USDC depegged from the dollar. Okay, it wasn't huge, but there was a moment where that project, USDC, looked at risk because it had, one would argue, some of the most liquid and high quality assets unavailable to it. It had US dollar in a US bank available to it to the tune of a few billion. And that bank had a run on it, where the bank closed its doors on a Friday, issued a notice saying no one can remove deposits, and Circle happened to have quite a few B in that particular bank account backing up their project. And they looked like they would be at risk at that point in time. And I think that's a really great learning opportunity for the entire industry, where the most liquid of assets, cash on deposit in a regulated bank, proved almost to be the unwinding of a bad crypto project. You know, bad using, bad crypto, you're an evil guy. Well, these were guys in suits in banks that are regulated that almost caused that. So making sure that the stable coins have access to liquidity in all sorts of forms to try and cater for every eventuality is almost an impossible task, but it is a big learning that was taken away by Jeremy and the team at Circle around having access to US dollar in a US bank, regulated bank, which suddenly was unavailable to them. I mean, who'd have thunk it, huh?
Yeah, there's another hot take that I always hear, and is that due to the nature of the public ledger, stablecoin transactions are public for everyone to see. What are your guys' view on privacy and maybe a method of private transactions with stablecoins?
Well, when I was at Cosmos, we collaborated with GFISMA, DJ Connect, in order to bring up to their attention this problem. As in, privacy is important, transparency is important. They're both equally important. There are technologies various implementations of zero-knowledge proofs that allow you to implement selective, you can fundamentally selective disclosure. There are algorithms that allows you to guarantee transparency, access to regulators only to those actors and entities that by their own nature have to investigate and monitor that reporting is correctly executed, so on and so forth. The thing is, privacy is important as well as transparency. So the answer is a compromise. At Yellow, fundamentally, we use the blockchain, so public networks, by leveraging their really intrinsic value, which is transparency. So the settlement, what we do with state channels, which are gradually becoming, we're very happy about it, they're gradually becoming more popular. We allow people to privately trade and settle in clear on Ethereum, Solana, or the network they please the most. So that's kind of symbolic to the right take, in my opinion. So you want your privacy, but also you have to report, you have to disclose to authorities.
Yeah, makes sense. I think we're nearing the 5 minutes here, so I want to ask each of you, like, imagine it's October 2027, you know, we're sitting here. Like, what can we do with stablecoins that we can't do now?
I would say we're on the cusp of seeing DeFi infrastructure used on the back end for people on the front end to use DeFi, to use fintechs and other traditional type apps connected to traditional finance, where they can deposit a stablecoin or deposit a pound or a dollar into an app, and that in the back end is then going to flow into DeFi, into the infrastructure that we have in places like Euler to generate yield. I think slowly but surely we're going to see that emerging, probably even this year, as quite a common theme, where people can earn more yield than they can by just using a traditional banking app, where you can maybe get today like 0.5%. People will be earning elevated yields because those yields will flow into disintermediated DeFi rails on the back end.
I'd like to see hundreds of thousands of stablecoin projects as part of stacks fueling innovation, not just for payment, not just for yield, but doing things that are particularly pertinent and close to my heart around privacy, the preservation of privacy, the ability for me to reclaim my online identity, my online data, and as part of that technology stack, allowing me to live less of my life in a digital space and more of my life in a real space, having agents powered by stable coins do things on my behalf and settle monetary units of value between other agents so that I can choose where I put my physical time, like spending it with you guys and getting to know you guys and chatting to these good folks.
Really nice.
Yeah, I mentioned the pilot that Visa Direct is currently doing with stablecoins, and I think in a couple of years' time, we're going to see a deeper penetration of stablecoins on the traditional payment rails such as Visa and MasterCard. It's something that they can't ignore, and they are pivoting their business models towards that, so we could see more consumer use of stablecoins.
I fully agree with Marc. I think we need more stablecoins. And stablecoins, if society is going toward a more digitalized shape, well, stablecoins are fundamentally the future of what are the traditional currencies. Yeah, many mistakes have been made. More mistakes will quite certainly come in the future. Our regulations are not there to stay as they are forever. They will change. And regulations are an opportunity for people that want to catch opportunities. So I think I fully agree with Marc, and they are the foundations. They will be the foundations of the future. They are already the foundations of the future. Many problems we'll have to find solutions somewhere by someone.
So I want to close it. As a consumer, I'm actually using an app which allows me to pay with stablecoins. It uses zero knowledge proof, so it's kind of private, kind of. But what I can't do is I can't just send those stablecoins to someone else that is either not on the blockchain or has the same app. So it would be nice in a few years to just be able to use your stablecoins and just send it to whoever doesn't even know anything about crypto and just receives USD or any kind of other stable coins there. I think that would be, for me, what I would love to see in a few years. I want to thank this panel. I hope you guys got some insightful and maybe things you could action, actually. Yeah, thank you, guys.
Thank you.
Thank you, Robin.
Thanks.